Hello guys, welcome to the sharpening session. Today is Saturday, September 4th. My name is Becky. My email address is here, which is becky@traddictiv.com, and then you've also got support@traddictiv.com. So any questions, of course, you can email either one of those if you have questions about what you see in today's video. Now, a sharpening session, for those that might not have joined me before on these, sharpening sessions we do on the weekend deliberately, because the only markets that are really open are the crypto markets. Everything else is closed over the weekend. So it gives us a bit more time to maybe expand on certain concepts that are not necessarily about placing trades right now or looking for trading opportunities right now, but expanding on things that people might be confused about, questions and answers, again, expanding on concepts and things like that. So today, I normally let you guys sort of dictate where this is going to go. So I'll keep an eye on the chat box, and if I see questions come in, by all means, I will focus on those. But today, what my plan was to do is to go through pros and cons of different markets. I've had some questions recently from those of you that follow us in the coaching community saying, you know, I trade this market, but actually it's not going so well for me. Maybe there might be another market. Or I trade this market, but I'm finding that there's not enough leverage. What would be another market that has more leverage? So I'll explain sort of pros and cons of each. I have no bias towards any of them. They are what they are. I always make analogies with this, that different trading vehicles that you can be trading, or different trading instruments you can be trading, is the same as getting in a different car. You could drive a lorry, you could drive a truck, you could drive a car, you could fly a plane. They're all great for what they're intended to be used for. But you wouldn't get in a Ferrari if you were going off-roading into the jungle. You wouldn't get in a lorry if you were having a drag race, right? So different vehicles are better for different things, and you want to make sure that you're in the right one for what you're trying to achieve. So I'll talk through the different sort of major asset classes you could be trading in, and pros and cons of them. Now, like I said, I'll keep my eye on the chat box. Let me just make sure I've got a few open here. I'll keep my eye on the chat box for those of you that do have questions or things like that, so that I can perhaps divert if you do have burning questions that you need answered in this session. Otherwise, hopefully the topic for today is helpful for you. Now, I just need to make sure that I cover disclaimers. So let me do that first. There you go. Disclaimers, top left-hand side. Of course, we need to cover them for legal reasons, but also important that you guys read it to understand that these kind of videos are demonstrations and aren't necessarily indicative of results that you might get, especially with sharpening as well, because it's much more theoretical and conceptual. Okay, so one more thing to show you before we get cracking, which is this link here, tradewithufos.com/Becky. Now, I bring you here because at this point you can set yourself up a free Trade with UFOs membership. So you just fill in the details there and click the next steps and go through like that. Get yourself a free Trade with UFOs membership. Once you've done that, you can scroll down and ask questions here in this area. It's a good place to do that because if you ask questions here, other people can see the questions and they can see the answers. So we can all learn from this space. In fact, a lot of the ideas I get in terms of what to cover in these sharpening sessions come from questions that are posted here. Because they're posted publicly, I can expand on them and do a whole video to answer your questions that you have. So please do put your questions there if you feel comfortable for them to be out in public. If not, of course, you can email me. But otherwise, I'd much prefer it that it goes there because we can all learn from it and I can expand on them separately in videos as well. Okay, so let's go to a chart here so that we can just use it as a backup if we need to. So, by the way, I should have said, we are streaming in different places at the same time right now. So we're streaming to Facebook, YouTube, LinkedIn, Twitch, other places as well. And we are also streaming inside our closed coaching community. Now, our closed coaching community, people pay a monthly fee, a small monthly fee, to be able to be part of that coaching community. And essentially what it means is that when we do these sessions, we get through to about halfway, and we'll either, if we're in sort of live trading environments, then we'll either make sure we place at least one trade, or for me in sharpening sessions, I might make sure that I cover at least one topic before we then cut the stream to the free channels and continue within that closed coaching community for those that are paying to be there. That's kind of how we balance that out. So if you're watching for free, you still get valuable stuff. You still see trades that we place. We still show you our methodology. We still go through topics for you. If you're within our closed coaching community, you're getting more of our time in that closed environment with extra trades and extra concepts. So hopefully that makes sense. Okay, so today's topic, like we said, is going to be asset classes and the pros and cons of each. So let's first start by explaining what they are. So you might have Forex, futures, options, stocks, and obviously much more recently, but very valid, cryptos. Good and bad for different reasons. They are what they are. Nothing wrong with any of them, nothing amazing about any of them. They have their place and they do certain things. Now, if we start with Forex, just very quickly, so let's start this up here and let's look at Forex. Forex stands for foreign exchange. It means you're trading currencies one against the other. Now, what I'll do is I'll give you some pros and I'll give you some cons, so you can see per asset class what might be good or bad about it. Now, the good thing about Forex is it's easy. There you go. Easy to get into. What I mean by that is if you Google open a Forex account, I'm sure you'll have one up and ready, running, ready to go within a few minutes. It's the biggest market by far in the world, by like trillions and trillions of transactions that happen in this market. It's easy to get into and it's cheap to get into compared to other markets. Now, obviously, if you're buying penny shares, then of course that's cheap too. Or even if you buy a stock that's worth $10, then great, that's cheap too. The great thing with Forex is that because of the leverage, I'll put this in here as well, because of the leverage, means you can have an account of a few $100s. Like anything, everything's a percentage. If you have an account of a few $100s, you're not going to make thousands straight away, of course not. Not how that works. But pretty much anyone with any budget can get involved in some way in the Forex markets. And again, what you have is obviously going to be linked to what you make. But it means you can start. With futures or in a lot of stocks and with options, you might need at least a few $1,000s to get started with that. Whereas Forex, a few $100s is enough. So Forex is the easiest to get into in terms of literally being able to open an account and how much money you need to open it. Now, the leverage also means that smaller moves can be worth more money to you, because for every, you might have leverage of, depending on where you are in the world, maybe 30 to 1. So for every $1 or €1 or £1 or whatever that you put in, you are controlling up to 30 times more than that, which means that you can have a smaller account. It also means that you control a lot more. Now that is great because it means that, let's say with a stock, if a stock is valued at, I don't know, $300, well, you need $300. If you want to buy 10 shares, and 10 shares isn't a lot, but if you want to buy 10 shares, you need $3,000. With Forex, not a problem. If what you're trading is worth $300 and you're doing 30 to 1, well, actually, unfortunately, I'm going to have to delete all of that, I think. There you go. If it's worth $300 and you're doing 30 to 1, well, actually, you only need $10 to do the same thing. So the leverage means that, again, you're using less money. You can get into more trades because less money is being used for your trades. So with Forex, we have, unfortunately, I think I might have to write that again. Oh no, that's cool, it's still there. So it's easy to get into, cheap to get into. Leverage means that you can use a smaller amount of money, get into more trades. Now, what are the negatives of Forex? By the way, obviously I'm going through each of the asset classes. We could talk about Forex for a full hour, if not longer. We could talk about futures for a full hour, if not longer. I'm giving you the in a nutshell for each of these things. Now, the negative things about Forex is it's easy to get into, meaning anyone with 50 quid and internet can get themselves a Forex account, whether they know how to trade it or not. There's not very many barriers to entry, which is great because it's accessible, but it's not great because it means that loads of people can open accounts, press buttons, don't know what they're doing, lose a bunch of money because they don't understand the leverage. With stocks, if it's worth $300 and you buy it for $300 and it goes to zero, then that's what you lose. In a leveraged environment, and I'll put here, not leverage, leverage is great, but it's misunderstanding. Misunderstanding or misuse, understanding. My spelling might not be great. Misuse of leverage. If you don't understand leverage and you do not manage your risk properly, if you get into something that's worth 30 times more than what you have in your account and it goes down or goes up, does the opposite of what you did, you could end up losing a lot more money, or you could end up losing your whole account very quickly. So leverage is great if you understand how to manage your risk and you understand how to use it properly. Frees up your capital to do other things. If you don't use it properly, or you don't manage your risk properly, it can be dangerous. So if you're going to trade Forex, just make sure you understand leverage and you understand position sizing and you understand risk management. And then you kind of eliminate that being a problem. Now, the other thing with Forex, which in my opinion, other people might do very well on this, I would say harder on smaller time frames. Now that's my personal experience here. What I mean by that is that because you have like trillions and trillions of transactions happening on Forex, because it's by far the biggest market in the world, it's not just anybody with 50 quid and Wi-Fi has got themselves an account, but it's also being traded and invested into by funds and banks and institutions all over the world, as well as everybody in business that's working in a different country that might have to transfer one currency to another. Everybody that goes on holiday that might have to transfer one currency to another. Everybody that has family or friends in different parts of the world and have to transfer one currency to the other. They're all part of this market, all making buy and sell orders for so many different reasons, making price go up and down for so many different reasons. So on a small time frame, if you're trying to time the markets, which is what a lot of traders try and do, if you're trying to time the markets and you've got all those millions, billions of orders going on for different reasons that are making it go up and down for different reasons, you've got to have a very, very tight strategy in order to be able, and when I say tight, I mean airtight, like it works, in order to make that a consistent profit for you. Not to say you can't day trade it or you can't be in and out on smaller time frames, or even scalp with Forex. You can. People do that and they make money doing it. It's just a bit harder. For me, I find Forex works better on a swing trading basis or slightly longer term. That's my personal experience with it. So Forex, it's great, easy to get into, cheap to get into, great leverage. It's easy to get into. That's a bad thing in terms of anyone can open an account without knowing what they're doing. That's dangerous. And if people misuse or misunderstand leverage, again, that can be dangerous. And in terms of day trading, I would say it's quite hard to combat all of what's going on in that world on small time frames. So that's Forex in a nutshell. I'm just checking the chat there, see if anyone's got any questions. Hopefully this makes sense so far. Okay, so we've done Forex. Let's now have a look at, let's do futures. So futures is the next one. Futures. Okay. Now, why is futures good or bad? Let's do good first. Futures, great for day trading. Access to many assets or instruments, products, whatever you want to call them. I can't do that like that. Assets, products, instruments. Okay, so what I mean by these things before I carry on. Great for day trading because it's a centralized exchange. I should probably put that in there. Centralized, depends where you are in the world as to whether you use a Z or an S there, but we'll do it with the American way. Centralized exchange. So what this means is you're not going to get different prices from different brokers. You're not going to get big spreads. In Forex, it's not a centralized exchange. It's going through all kinds of different people to be fulfilled, as in order for a buyer and seller to meet, it's going through all kinds of different exchanges, all kinds of different sort of routing systems. With futures, it's going to a centralized exchange, which means the price is the price is the price. It's not different with different places. The furthest extreme of this is cryptos. Cryptos is really different. With Forex being such a big market, you look at one Forex broker and another Forex broker, they might be a pip difference, as in the smallest increment of price, a tiny bit different between what the prices are. Might be 2-3 pips, depending on the volatility. Maybe that might spike to 10 pips, but they're relatively similar. with cryptos, you could be talking, let's say Bitcoin, you could be talking thousands of dollars of difference in terms of the value of Bitcoin, depending on which broker you're using and which exchange you're using. With futures, that's not a problem. It's a centralized exchange, which means you're not losing, or you're not going against that spread, you're not going against that difference all of the time. And you sometimes, in things like Forex and cryptos, you might have your broker trading against you. In futures, again, not a problem, because it's all going through to a centralized exchange. That makes it great for day trading, because you have less movements that are for random reasons, less movements that are broker related, and less movements that are, where you're getting a spread that's stopping you out. So great for day trading in that way. Also, you have contracts that expire within certain periods of time, which means that, again, a lot of the volume is in the shorter time frames, which is great. So great for day trading. Access to many assets. So with that, you can trade futures on currencies. Futures are contracts that represent other things, basically. So you can trade futures on currencies, futures on stocks, futures on wheat, gold, corn, oil, cattle, lean hogs, orange juice, coffee, cotton. You can trade futures on so many things, which means instead of buying that thing, instead of going and buying oil itself, you buy a futures contract of oil, which is leveraged. So the leverage, again, enables you to be owning things, or enables you to be buying and selling things, profiting on the movements of things that might cost a lot more money than what you have in your account, which again is great, because if you can trade 1,000 barrels of oil, and I don't know this number off the top of my head, depends on your broker and things, but let's say you need $3,000 in your account to trade the equivalent of 1,000 barrels of oil. Well, let's say oil's trading at $50 a barrel, making that up. If you were going to trade 1,000 barrels of oil at $50 a barrel, that's $50,000 that you'd need. But instead you only need $3,000 in order to do that, because of the leverage that's in your account, which means you can be trading things that are worth much more money than what you've got in your account. Again, same principle of leverage that we talked about before with Forex. So it's great in that way. Now, the negatives of futures is that account opening slightly higher. Now, we do now have things called micro futures and micro e-minis, which means you actually need an even smaller account than what you used to be. But in general, if you want to be in multiple futures trades at the same time, you might need $5,000-ish minimum, maybe slightly less, if you want to be trading different things. If you want to be in and out in the day, then on one thing, then maybe with a micro futures that you can trade, you might only need $500. But if you want to be in different assets and you want to be taking advantage of the assets that you have access to, and you want to be in more than one trade at the same time, you might be looking at a few $1,000s that you need, which is fine for a lot of people. For other people, it prices them out. So that might be a negative there. The other thing with futures is the expirations. It's not necessarily a negative, just is what it is. Futures expire at different times, which means you've got to be aware of that. It's an extra level of complexity that you don't have with things like Forex and stocks. With things like Forex and stocks, you can buy it now and leave it for years and years, forget all about it if you want to. You either have won or lost money, but you didn't need to necessarily do anything in between. With futures, you need to be getting out of trades as you approach the end of that expiration, and again trying to get back into the next trade at the start of the new one. So you have to be looking at not just the asset, but the relevant contract that's not expiring soon, unless that's your strategy. So you've got to basically bear in mind more things with futures than you would with other markets. So far, I know I might be going through this a little bit quickly. For some of you, you already know this, in which case it might be slow for you. If you have any questions on this, by all means, if I'm saying stuff that doesn't make sense to you, please, please, please either ask the question on the tradewithufos.com/Becky link, or email me. I'm happy to clarify anything, and I can always do another session to perhaps expand on it in more depth as well if people need that. But here's a summary of futures, okay? Now let's look at let's look at stocks before we go to options, because options is a bit more complex. So stocks, most people, if you don't know anything about trading, you've at least heard of stocks. Some people don't know the acronym of Forex, but they know what currency exchange is. But stocks, when you think of investing, it's what most people think of. So again, it's more well understood, less to understand in terms of the mechanics of stocks than you would with something else. With stocks, we understand they move up and down based on, is it a US stock, therefore it moves up and down in dollars and cents? Is it a UK stock, therefore it moves up and down in pounds and pence? Is it a European stock, therefore it moves up and down in terms of the value of the euro and denominations from that? So stocks are easy in that sense, in the fact that they have less things you have to learn about them, because we already have a decent understanding, most of us, or at least what a stock is. Now with stocks, the good thing is, tend to go up over time. Disclaimer, of course they crash as well. Of course some of them go to zero and companies disappear. Sometimes we have stock crashes that last a couple of years and people halve their money. So I'm not saying that these are like a safe bet. I'm just saying that in general, if we look at the data and the statistics and look at the trends over time, they tend to go up over time, which makes them great for longer term. Makes them great to invest into. That's the reason why most pensions are in stocks. That's the reason why most investments are in stocks. Now, they're great for the longer term in that sense, and they also give you exposure to economies, which is great. So perhaps we can put that in there as well. Exposure to economies. And what I mean by that is that if you think of the richest people in the world, Jeff Bezos, Elon Musk, Bill Gates, what do they all have in common? Other than that, they're middle-aged white men. Other than that, what do they have in common? They own businesses. They are business owners. Some of the ways, or one of the ways to get extremely rich is by being a business owner. What investing in stocks allows you to do is own a tiny, tiny part of these businesses and profit from their hard work, profit from them doing well in their businesses, and you're taking that tiny, tiny bit out of it. You also might get things like dividends, where you're getting paid a set amount per share. So it might be $2 per share. That would be a lot, but it might be, I don't know, 50 cents per share. 50 cents per share that you're getting paid every quarter. Well, if you've got 10 shares, then that's $5 every quarter. Great. If it's 100 shares, then you're getting $50 every quarter. If it's 1,000 shares, then you're getting $500 every quarter. You see my point? Is that you're just making money, a set amount of money, as a result of being involved in that stock. Whether it goes up or down, you're going to be making a set amount every quarter. That's also not a bad thing. So stocks are good for these things. The negatives of stocks. I'm going to maybe might not have the room here, but exposure to economies is, of course, a negative as well. If those markets go down, if the economy suffers, if we have a recession, or we have a pandemic, or we have a bubble of some kind, like we've seen in 2000 with the tech bubble, and we saw in 2008 with the sort of property market crash as well. If you're in stocks without any risk management, you are exposed to 50% crashes roughly every 10 years. That's kind of the cycle that they do. And again, this is averages over time, right? So that can be a negative thing, that you're exposed to that. Now, the other bad thing with stocks, I would say, is that you have overnight gaps and weekend gaps. To be fair, you have weekend gaps in other markets as well. What I mean by overnight gaps is that the stock market opens, depending on where you are in the world, opens at 8:30, 9 o'clock, closes at 4:30, 5 o'clock, right? So it's open for 8 hours a day and it's closed for 16 hours a day. Stocks can't move in those 16 hours because the stock market is closed. They cannot go up or down. But a lot can happen in 16 hours, a lot more in 16 hours than can happen in 8. That could influence the value of these stocks, and then the next morning it was here the day you left it, and now it's here the next morning. Just jumps. You're exposed to a gap in price, even if you have a stop loss, and your stop loss is here, say. You've gapped way past that and you'll get filled on your stop down here. That doesn't happen so much in other markets. In Forex, it's very rare to see a daily gap. In stocks, it's nearly every day. Nearly every day you'll have some form of gap in nearly every stock. Why? Because things happen in a 16-hour period that change its value. That means the next morning it opens up at a different price than what it closed at the night before. And so you're exposed to that. Again, there are ways that you can overcome that, but it's something that you could be exposed to. The biggest issue, I think, with stocks, and this is what people have been sharing with me as well, is lack of leverage. Meaning, you might see this as a safe thing, but actually leverage is not dangerous if you understand it and use it properly. The same as a Ferrari, if you're a good driver, is actually safer for you than a just cheap normal car, a Kia. Why? Because they're built better. They've got better crumple zones and they've got better ways to protect the driver. A Ferrari, if you don't know how to drive, could be more dangerous than a Kia because it goes faster. So leverage is kind of like that. If you understand leverage, if you're a good driver, leverage is great for you. It's not dangerous. If anything, can end up being safer in terms of the way that you can position size and manage your risk. If you're not a good driver, if you don't understand leverage and you don't understand how to use it, keep away from it. Get in the Kia Picanto. That will be better for you. So the same thing here with stocks. The issue with stocks is that they have a lack of leverage, meaning if it costs $2,000 a share, then you need $2,000 to buy one share. If it costs $10,000 a share, you need $10,000 to buy that share. Which means, let's say you want to be in and out of different stocks. Some of them are worth $250. Some of them are worth $1,000. Some of them are worth $500. Some of them are worth $100. You see what I mean? If you want to be in different trades, you might need to have a bigger account in order to really be able to place those trades. And they might go up 50 cents, which means you made 50 cents per share. Whereas in Forex, it might go up a small amount, but because of the way you've position sized and used the leverage, you might make a lot of money in that small amount. Whereas in stocks, it moves with what it moves by, and that's what you make per share. So again, good and bad about different things. Hopefully this is making sense in terms of stocks. I'm just checking the chat boxes, see if people have any questions. Doesn't look like it. Again, honestly, if you're new to trading, this might be overwhelming to be hearing about these different things. Let me know if you have any questions, of course, please do. So those are the pros and cons of stocks. Let's have a look at options. And again, by the way, just to say, I know that there are many more features to these markets, of course, that some of you that are a bit more advanced might be saying, oh, why didn't you mention that? Or why did you do this? I'm trying to give, in as quickly as I can, a nutshell version of what the pros and cons of these markets are. So for those of you that are a little bit more advanced, apologies if I'm missing out on some features that you think are important to cover. But for those of you that are new, also hopefully that I'm not going too fast and overwhelming you. So with options, options give you options, says Jose all the time. So a good thing about options is they give you options. There are so many things you can do with options. You can make money if price goes up, down, sideways. You can put in strategies that mean that you can be right even when you're wrong, and you make money even if you were absolutely wrong on your judgment of where the price will go. It gives you many different things to do. You also have leverage on options, again meaning that you need less money in your account than what the actual value of the thing is, which is great. Leverage is great if you know how to use it. So leverage is a good thing with options. Now, another good thing about options is they can work as protection. So let's say you have stocks and you own stocks, or even you have futures contracts, or even you own funds that are invested in oil or gold or whatever. You can use options on those funds to protect them, which is perhaps a better way of doing it than having a stop loss, or maybe both and be doubly protected. Maybe you have options that mean that you can, we'll do it with here, you can collect money from selling options, and you can sell an option you don't own. So you can sell an option and just collect money. Now, of course, if it was as simple as that, if that's all you had to do, everybody would just sell options and collect money. It's obviously more complex than that. But there are strategies you can use where you can collect money from selling options where you're very unlikely to be wrong. That's really great. So you can, I'm going to give you options / increase, I'm going to put here probabilities. Probability. Okay, you know what that word says, probability. What I mean by that is there are options within options where you could make sure you have a probability rate of 90+%. If you ask any trader in the world that trades anything else other than options, would you like a probability rate of 90%? They would bite your hand off for it. But the negative side of options, they are complex. Much more complex than the other markets. It takes a lot longer to learn and understand options than the other markets. I myself, I'm not an options expert. I could explain to you the ins and outs of Forex and stocks and cryptos and futures, but with options, there's a point where I get to where I don't know that. If you want more understanding on options, by the way, check out Jose's sessions. They're called Options with Options. Check out Jose's sessions. He's really, really great at explaining them and using them. He's an options god, so follow him. So they are complex. That's a negative thing. It takes a while to understand these things. You've got not just prices moving up and down. You buy the right to buy and buy the right to sell and sell the right to buy and sell the right to sell, and you can do combinations of those in all sorts of weird and wonderful ways. You also got things like the Greeks, which are the value of options. Some of them might be based on how quickly price moves or how close it is to expiration or other things like that. So they are complex. That's one of the biggest downsides of options. But also, if you're willing to overcome that, you get access to the great side of options, was that it gives you options. More expensive accounts. Now what I mean by that is you can, again, there are option strategies where you can just buy calls and or buy puts, and you buy whatever the value of the option is, and you don't need very much money for that, maybe a few $100s. But if you really want to be getting into using the options that are available to you within options, you probably need about $10,000 or more in order to be able to make the best use out of it. So again, depending on what you do with options actually really depends on whether or not this is a pro or a con. But normally, especially if you want to be taking advantage of the different choices you have, you're going to need more in your account to do that because of how they work. Now the other side is, if you misunderstand them, there could be greater risk. What's silly is actually with options, you can put things in where you're increasing your probability and you can make money even when you're wrong. And so your risk is minuscule, or if not even there in some cases. But, and I'll make more clear of this, but if misused, if you're selling options with no plan, that you don't understand what you're doing and you haven't done other things to counteract that, you might end up having to come up with a lot of money because you were wrong, which doesn't happen in those other markets. So again, pros and cons of everything. With options, I would say if you're willing to learn it and put in the time and effort to learn it, a lot of these negatives can actually be overcome. It's just that it takes a bit to learn how to do it, and you want to make sure you don't really make mistakes along the way if you don't understand what you're doing. So last market before we cut the live stream, and then we'll look at, for those of you that stay in the closed coaching community, we'll then look at some situations where you can be using the different scans on top, which is our platform, and TradeStation, depending on which markets you're trading, that might help you decide which markets you're going to be looking at. So with this last market, so far we've looked at Forex, futures, stocks and options. Let's now look at the last market, a major asset class, which is cryptos. So pros of cryptos. I want to say easily accessible. Easily accessible, volatile. Volatility is a good and bad thing. We'll get to that in a minute. Volatile meaning we've seen Bitcoin has, what, in the last couple of years, it's times by 5, something like that. not many other markets in the world have times by 5 in the last couple of years, let alone maybe cryptos that might have been worth a little bit less money and they've done a relatively small move, but because they were worth less money, it's actually a really big percentage gain. I've personally met people that got involved in Bitcoin 10, 15 years ago, bought a few $1,000s worth as a punt, as a see what happens, and they're now millionaires from that. So that volatility, if you're on the right side of it and you're lucky, is great because they move far quickly. So if you're on the right side of it, you can make money quickly. There is a negative side of that, which we'll get to in a second. Also, the fundamentals, depending on how you feel about this, there could be good things with cryptos in terms of how the blockchain actually works, being able to be in an environment where there is no centralized exchange, there is no bank checking on what you're doing, there is no government involved. It's sort of free for the people. Again, there's pros and cons to that as well. So cryptos can be great for these reasons. Now, some of the negatives of cryptos. Firstly, I would say volatility, unregulated, and the differences between brokers. I guess that's linked to being unregulated. I would say decentralized is a problem. So volatility. If you're on the wrong side of it, that can hurt you. If it goes up and down very quickly, and by the way, we're talking, if you think of the US dollar goes up or down in a year by about 5-6%. Bitcoin goes up or down in a year by about 100%. So it's 20 times more volatile than the US dollar. So again, if you're on the right side of that, you could make 20 times more money. If you're on the wrong side of that, you could lose money 20 times quicker. Or lose 20 times more money than what you'd make if you were in, or than what you'd lose if you were in another market. So the volatility can be a problem. We saw with Bitcoin a few years ago, it reached $20,000-ish. It then dropped within weeks and stayed there for years. And then has recently shot up again. So again, if you got in, unfortunately, at that high a few years ago, it then dropped, halved, within a few weeks, actually more than halved within a few weeks, you've lost a lot very quickly. So that can be a problem. So again, with all of these markets, you need to know what you're doing in them in order to make the pros more of a reality to you and avoid what the cons might be. The good thing about cryptos as well, I'll just change this and put this here, is that they are, well, I guess easily accessible, puts that in there as well. So in terms of logistically, and also funding. What I mean by that is you can buy a crypto that is worth $1, $2. That perhaps, if you're on the right side of it with volatility, might go to $10,000 like Bitcoin did, you know, in the early years. And you make a lot of money, and you didn't need very much money to do that. You can also buy a bit of a Bitcoin. So even though it's worth $50,000, you could still get in with $2 because you're just going to buy 0.0000000 whatever of the Bitcoin. So it's easily accessible in terms of anyone with any amount of money can get in. Logistically, again, just Google where do I buy Bitcoin? You'll see loads of places that you can do it. The volatility, if you're on the right side, is a good thing, and fundamentally perhaps a good thing in terms of the future of what currency means, or the future of what you know, transactions really are. But the volatility can be a problem. It's unregulated. I didn't mean to do that. We know what I did there. Unregulated. That is a good thing in terms of the fundamentals, meaning there's nobody looking at what you're doing. What it also means is that it's very easy for people to set up crypto brokerages. You put your money in, they disappear with your money. Not much you can do about it. There's no central place that's protecting you with cryptos. If you forget your password, you forget your password. That's it. If you have a banking app, let's say you're with Barclays as a bank and you forget your password, well, it's all centralized and it's regulated, and they have to protect you and they have to protect your money. So they will help you to get back into your account if you forget your password. You just go through security things. With cryptos, it's getting better now in terms of the sort of two-factor authentications and stuff. But you're still in a situation where if something goes badly, there's nobody there to help you. There is no insurance, there is no regulation, there's nothing. So if that exchange goes bust, and laws change on this really quickly that actually ban certain exchanges or certain cryptos, then sorry, that's, you know, that's what you get. That's kind of how that works with cryptos, which is unfortunate. It's decentralized, which again is a good thing for it from the fundamental side of it, but decentralized in the sense that you will see vastly different numbers from different brokers, which makes it hard potentially to know what to do. They're also really high, really expensive relatively in terms of fees, really high. Like your withdrawal fees and deposit fees and trading fees, and your transfer fees to go from one to the other. It's extortionate compared to Forex, compared to stocks. On stocks, you don't pay any commissions anymore. You pay a tiny fee to the exchange, but you don't pay any broker commissions anymore. And normally they will let you withdraw and deposit without any fees, or if they do, it's a small amount. But with cryptos, you might get charged a $50 flat fee to withdraw plus a percentage of whatever you're withdrawing. You might get charged 0.1% of every single trade as a commission, as well as a huge spread, because there's no centralized price. It's, you know, there's huge spreads. So again, pros and cons to everything. With all of these, know why you might be trading them. Know what works best for you and understand that market in and out before you go placing trades, risking money, and perhaps losing money because you didn't understand it. What's really interesting with crypto, which I realized for myself the other day actually, is that if you were to look at, what's the Trustpilot? If you were to look at Trustpilot and you put in crypto exchanges, they have terrible reviews from thousands of people complaining about fees and volatility of the cryptos themselves, that they bought a crypto and now they've got no money because the crypto disappeared and whatever. That's not the broker's fault. That's because people don't understand it. People don't understand what cryptos are. They think, I'll go in, I'll buy something and I'll make money on it. Not realizing that they're going and buying a crypto that they heard their mate talk about and it disappeared the next day, because they're popping up and disappearing all the time. They are putting money into things and being charged a high amount of fees without understanding that that's industry average, because they're comparing it to banking, which they think should be like that. It's not. It's a completely different animal. So understand what you're doing, and then great, go do it. There's nothing right or wrong about trading cryptos, nothing right or wrong about trading stocks or futures or Forex or options or combinations of those things. Nothing wrong with any of them. If you know what you're doing, they can be beautiful things that can make you money, that can give you security. If you don't know what you're doing, there's dangers in all of them. So hopefully that's my 5 major asset classes summary, nutshell of what's good and bad about them, which might help to give you a little bit of an idea as to what makes more sense for you, what might be a better thing to do or not do, depending on the pros and cons and what kind of speaks to you or not. If you have any questions or you're thinking, oh, what about this, please email me, or like I said at the start, go to tradewithufos.com/Becky, get yourself a free membership if you don't already, and then post the question here, because then other people will see that question and other people will see the answer, and I'm sure there'll be other people in future that will need to have the answers to these questions if you have them. So by all means, please do place them there. What I'm going to do now is cut the stream to the free streaming services, and I'm going to continue in the closed coaching environment. So for those of you that have joined me on the free platform so far, hopefully this was helpful. Weren't particularly chatty today, but a few of you have been with me the whole time, so I'm hoping that that's been helpful for you. Like I say, any questions, let me know. I'll be back on Monday for the market commentary at 1:30 my time, which is in the UK, which is 8:30. No. Yeah, 8:30 in New York. So I'll see you guys on Monday if you join me for that. Otherwise, like I said, let me know if you have any questions. Have a great rest of your weekend. I'll see you soon. For those of you in the closed coaching community, just wait for me there. I need to cut the stream. I need to do it one by one. It takes me a second, and then we'll continue for the last 15 minutes or so in that session. All right, see you later, guys.